Welcome to Right on the Money, the weekly talk show with interviews you can use to help you maximize your money and optimize your financial future. Before moving forward with any of the ideas discussed on the show, always consult your financial advisor, insurance professional, or tax consultant. Looking for financial help or a second opinion? We can help you in your search. And now, your host of Right on the Money, syndicated financial columnist and money-colored commentator, Steve Savant.
Well, welcome everyone to our money tips for the new year to help us get on track for 2016. And here to bring us up to speed is registered financial consultant and investment advisor, Ted Meyer. And Ted, when we're talking about this, we're talking about the right asset mix. You know, I always think about, well, I want a floor and a guarantee. There's one.
Yep.
You know, I'm looking still for a little bit of growth. There's two.
Yep.
I don't know if I have the propensity for any of this because I don't know if I can risk things.
If I can stand the risk.
Well, let's talk about that. I'm going to suggest to our audience today that if you've never taken a risk tolerance test, it's not an end-all, it's not perfect.
Starting point.
It's got a very good starting point. If you've never taken a good risk tolerance test, and I have that, if you want, you can order it. I'll say, write me at steve@rightonthemoneyshow.com, and I'll send it to you. You know, just because you need to really look at some of these things, I think that'll really help you. A risk tolerance test, the one I do is about 10 minutes max.
They're usually 10, 15 questions.
You're going to have some questions, and it's going to give me an idea of where you're at. Now I'm going to ask you this, Ted. You've been in this thing now for a little while.
Yep.
How come when I I have a client take a risk tolerance test, and then I look at his 401k portfolio, they don't match. Their risk is, you know, they're conservative by the test.
Yep.
I'm looking at their portfolio, and it's aggressive.
It makes no sense, to be honest with you. None of it matches up. I think folks look at their 401ks as something that I'm not going to touch until I retire, whether it's 5, 10, 15, 20 years down the road. So they look at the funds that are available to them inside their 401k. They might have 5, 10, 15, 30, 50 different options in there. They look at last year's returns. They pick the one that did the best. They circle it, and they go, put all my money in that. And they don't understand. They don't have an advisor helping them with their 401k. And you saw that happen back in 2000 when you had all these folks at or near retirement, and their 401ks took a dive. You saw it happen again in 2008. So it's important that your 401k matches up with your risk tolerance.
Now, I've noticed this in a little tribute to women here, that when I have a female take a risk tolerance test and I look at her 401k, it's actually pretty in the
similar.
game.
Yeah.
It's very similar.
As men, we like to take a little more risk.
Well, that tells me that guys are psychopathic liars. Okay. But bottom line, we want to look at risk tolerance test for our portfolio mix.
Correct.
We want to look at liquidity. Do I have liquid money I can get to in case I need it?
Correct.
How big is liquidity in retirement?
Liquidity is huge in retirement, especially when you're looking at a retirement red zone. As we said, those first 5 years of retirement, it's a whole new ballgame for you. You're not sure how much. It's better to have a little more liquidity in the first 5 years as you ease into retirement than it is to be having to sell things to get out of and get cash.
Now, Ted, I'm going to put you on the spot a little bit here. You know, I have young guys in their 35. He came to me, he's 35. We were at one of those cocktail hours you go to at a Christmas party.
Yep.
And he says, Steve, I have 30, 40 years to go before I retire, so I have plenty of time. I was told by my advisor that I should just go ahead and put it to the wall. Aggressive growth funds, you know. Is time the dictator in this? I mean, is that an indicator?
Time is one of the indicators, but it's certainly not the most important. There's an old rule of thumb that says take the age 100, subtract your age from that, and that's the amount of risk that you should have. So if you're a 35-year-old gentleman, you should have 65%, the reverse of that, in risky investments.
Okay, but let me ask you this though. What if
that's just the starting point.
That's the starting part. So let's say I agree with your thing. I say, hey, I got plenty of time. But then I did the test.
Yep.
And I am like, wow, I am a kind of a moderate conservative here.
There you go.
All right, now I go through 2008. Now remember, a lot of the millennials, they started into the market with their 401ks about year 2000. We had 4 loser years in that 4 period with S&P 500.
Large loser year.
Okay, big one. And remember, 2001, 2, and 3 were accumulating. That was accumulated losses 3 years in a row.
Correct.
Now, I'm thinking that when we got to the 10th year, they were even money maybe.
If they're
maybe.
lucky, they were even money.
They were even money maybe. So even though they may have all this time, I've noticed that sometimes if you don't have the psychological, intestinal fortitude.
If you think about what keeps us up at night when we go to bed.
Yeah, that's it.
For a lot of baby boomers and folks that are working right now, it's how is my money performing? And if you went through 2009, 10, in 2009 and 2010, those were 2 10-year decades in a row where your money was flat or down.
Yeah.
And if that keeps you up at night, then your risk tolerance isn't as high as you think.
Right. And I think you need to be honest.
By taking that test.
I'm thinking like Shakespeare says, to thy own self be true. You need to really take this test
Yes.
and be honest about it. We're not trying to hit a home run. We're trying to impress people at the cocktail
Right.
hour at the at the golf course.
And then I recommend taking a test every couple years after that, because your feelings about this stuff is going to change.
Now, I've noticed that some people complain about their returns. They just don't seem to add up. And part of that I've noticed is the actual fund or
Fund expenses.
expenses or any product. Right? Most products have expenses. So I don't care what they are.
Yes.
So they're all going to have
Nothing's for free.
products. My issue is it's full disclosure. For example, 4 years ago, we had introduced to
403B.
us the 408B2.
Yep.
This 408B2 said you have to fully disclose all charges in your 401k so the participant of the 401k knows what he's getting into.
Correct.
Okay, that was new. So when we got that, we found out, oh my gosh, there's some admin charges here, some compliance 404C compliance charges. There's some numbers, but what really got me was that the expense charges of the fund, that I've known because we have to have that
Right, that's disclosed.
disclosed in the prospectus. But you said, oh no, there's more.
There's more of that. There's something called the Statement of Additional Information called the SIA. The SIA is another piece that should be disclosed to everybody that also talks about the cost of the fund, things that you don't see, the marketing costs, a few other things that are in there that can add up to a lot of money over time. It doesn't seem like a big deal now, but I think the last report from Morningstar said that averages about 1.44% per mutual fund. So if you look at the expense of a fund, let's say you're paying 1% for the fund, you add another 1.44 of SIA fees on the back end, then you put on your investment advisor's fee on top of that. You're 3.5%, 4% before you even get a return.
And well, I'm going to stop you there. Okay, I just want to make sure we got this correct. In the prospectus, it's going to disclose the fund's expense.
The expense load,
But
correct.
but the SAI, Statement of Additional Information, is not in the prospectus. Is that what you're saying?
It is not in the perspective. Correct.
There might be a few out there, I don't know, but most of them, no.
Yeah. Generally speaking, it's not there.
If I go out to I got to the internet, I can find it as a client, but nobody told me I even needed to track it down.
Yeah. And you need to track it down because when you look at this stuff and you think about the things you control when you're investing, I can control the amount of risk I take. I control, to some extent, the taxes, and I need to control the fees. Well, you can only control the fees once you have full disclosure on what all the fees are.
Well, I'm trying to always think of full disclosure to the client to understand when we're shopping and we're doing things on the basis of expense loads, we need to incorporate the SAI, the Statement of Information fee, these extra costs.
Yes.
We need to, if we're in a 401k, we need to look at the full disclosure. Although now that's with 408B2, that's online. We should be able to have access
And
to it.
that's gaining headwind out there, but there are still a lot of 401k plans out there that the participants don't understand the fund expenses, the investment advisor expenses, company expenses that are in there.
I'm thinking when you're looking at a fund, you want to try to figure out what's my best return based on my beta risk. I've taken the test. I kind of know where I'm at. And then who's pricing this the best? Because, that really matters. And I've seen commercials on television that underline and underscore this where it says, listen, over these years, there's thousands and thousands of dollars being spent on expenses.
Yeah, when you just look at an expense of 1% over 10 years, that's a significant amount of money.
Well, to me, that's a big issue. And listen, we're always looking for fixed assets. I want to park money in money market funds. I just found out, oh my gosh, my money market fund is paying nothing and they're still charging me. What's
Yeah.
with that?
Yeah, that's what's going on right now. 10, 15, 20 years, we had CDs that were paying 4, 5, 6%. Some of you still remember days when you had double-digit returns on CDs. And those came due, and it's like, where do I go now? Well, I think if you go on websites like Bankrate and try and find out national averages on CDs, if you can get 1 right now, that's fantastic. If you extend 4 or 5 years, they might give you 1.5, 2, 2.25. But that's not enough to live on. And so a lot of folks come to us and say, I've got my part that's in equity. I need my stuff that's safe, and I need safe alternatives. And you look at safe alternatives, you've got CDs, you got money markets. Well, those aren't paying anything. So we start looking to the insurance industry, and we start looking at things like guaranteed income annuities, or we look at things like annuities that pay a set rate of return over a period of time that compete with CDs out there. So you can get a fixed rate annuity that might be a 3-year or a 5-year or something like that. Those rates are typically higher than CDs right now.
And you don't have to pay taxes until
And you don't
actually
pay
use the money.
taxes, which is nice. And then if some of you want, you take a look at index annuities where you might be able to get a little higher return, but it's not as friendly as the
And just
fixed
remember,
rate
when you're
annuity.
thinking about expectations on returns, I mean, here, as we close out the show, I mean, you're trying to pull from your 401k and so forth. You're saying, well, I'm going to pull 6%. I don't know about that. 4%. I don't know. I think we're down around 3 right now.
I think I saw 3.8 the other day was
and
the expected rate.
You better start looking at how conservative we can pull this money out.
I mean, you start looking at a portfolio where someone had, $500,000 20 years ago, and we could run an average rate of return of 8% on that. That's $40,000 that they could usually take off of that and not worry too much. And now you've gone from 8 to 6 to 4 to somewhere in the 3s. 4% on $500,000 is $20,000 a year. That doesn't help a lot of folks.
No,
They need additional income from that standpoint.
I really want us to have a wake-up call so that we can understand our money. It's going to be our retirement. It's going to be a long retirement.
Yes.
I want to make sure that I have decent expectations on returns, expenses, taxes. All this matters. As I've said time and time again, this is not a do-it-yourself job.
No, it's not.
Well, it's our retirement. We're talking about that, and that's our show for this week. I want to thank Ted Meyer for being my guest. But before I go, I want you to remember what the good Reverend John Wesley once said. Make all you can, give all you can, save all you can. I'm Steve Savant. We'll see you next week.
For more information on this week's money topics, just go to our website at www.rightonthemoneyshow.com and follow Steve's daily postings on Facebook, Twitter, and LinkedIn. When it comes to retirement, money management, small business, insurance coverage, college funding, or budgeting, we have the interviews you can use.